Chapter 6, Saving and Investing. Why it's important. Why should you save? What is the difference between saving and investing? This chapter will explain reasons for saving as well as the various institutions and investments in which to put your money. Most Americans make more income than they require for immediate needs. At the same time, many large purchases cost more than a worker earns in a single pay period. Thus, wage earners must decide whether to save their extra earnings for large purchases or to invest them for future use. Chapter 6 describes various types of savings accounts and investment opportunities and explains their advantages and disadvantages. Section 1 describes the different kinds of savings accounts available through savings institutions and explains the advantages and disadvantages of time deposits as compared to other savings accounts. Economists define saving as the setting aside of income for a period of time so that it can be used later. You may already be saving some of your income for a future use, such as buying a gaming system or continuing your education. As you read this section, you'll learn why saving is important to you and the economy as a whole. In 1967, Americans saved around 8.6% of their disposable income. By 1996, that amount dropped to 4.3%. Why do people save money? Where do they keep the money that they have saved? Deciding to save. People save for purchases that require more funds than available for emergencies and for retirement. Economies benefit from individuals who save because people have more money to invest or spend, leading to expanding business. When choosing a place to save, think about trade-offs. Passbook, regular, or statement savings accounts accrue a low interest, but they allow immediate access to funds. Money market accounts accrue higher interest with immediate access through checks, but they have a high minimum balance requirement. Time deposits. Time deposits refer to a wide group of savings plans or certificates of deposit, also known as CDs, with a high interest rate that increases over time. But a person cannot remove the funds before a certain time period or maturity without paying a penalty. Before the 1930s, people could lose all of the money in their accounts if the bank failed. Fortunately today, banks are insured by the FDIC. Most banks are FDIC insured, which is the Federal Deposit Insurance Corporation. So this is a federal government-owned corporation that insures bank accounts in FDIC member banks up to $250,000, giving people security when making deposits. Section 2 describes and explains stocks and bonds and the differences between them, and how the government regulates the stock and bond markets. People have savings plans because they want a safe rate of interest. If people are willing to take a chance on earning a higher rate of return, however, they can invest their savings in other ways, such as in stocks and bonds. Stocks and bonds offer investors greater returns, but with more risk. As you read in this section, you'll learn what stocks and bonds are and why they carry a risk. In 1792, a group of 24 businessmen met under a buttonwood tree in New York City. In 1817, a building was built on this spot and formally made into the New York Stock Exchange Board. Since 1863, it has been known as the New York Stock Exchange. Why do companies sell stocks? Why do people purchase stocks? Stocks entitle the buyer to future profits and assets of a corporation. Stockholders make money through dividends, which is return on bought stock, or by speculating, buying stock hoping that it will increase in price so that they can sell it at a profit. A capital gain is money earned by selling stock for more than you paid for it. A capital loss is money lost by selling stock for less than you paid for it. A bond is a certificate promising to repay a loan at a stated interest rate. Stocks and bonds. A bond holder is not part owner of the organization. Tax-exempt bonds earn tax-free interest. With savings bonds, you pay half the bond's face value, and the interest increases yearly until the face value is reached. T-bills, T-notes, and T-bonds are government bonds that are exempt from state and local tax and are mainly for larger investments. Stocks are bought and sold through brokers. Stocks are traded at stock exchanges. Stocks that are not traded in a specific place are called over-the-counter stocks. Bonds are sold on exchanges and over-the-counter markets. Mutual funds are investment companies that combine many investors' funds to buy a large variety and quantity of stocks. Some mutual funds mirror index funds. Managed mutual funds have managers who adjust the mix of the stocks bought and attempting to generate the highest yield. Money market mutual funds allow investors to write checks against the money in the fund. Government regulations. The Securities and Exchange Commission, or SEC, regulates brokerage firms, stock exchanges, and most businesses that issue stock. Congress passed the Securities Act to avoid another stock market crash. The act requires a prospectus to be given to each potential buyer of stocks or bonds. A prospectus is basically a detailed statement on a company that includes the financial health and outlook of the company. Section 3 describes the types of retirement plans available and discusses investment strategy. One of the reasons that people save is to send their children to college. Another reason is to have income to spend when they retire. In addition to their savings, most Americans will need additional sources of income for the years after they stop working. As you read in this section, you'll learn what those additional sources of income are and the amount of risk involved in these investments. In 1964, Warren Buffett took over Berkshire Hathaway. He believes in value investing, buying a stock because of a belief in the company's value for the long term. In 1998, the company's Class A stock sold for a high of $84,000 a share. In the 1970s, those same shares were selling for about $400. What other kinds of investments are available for people who want to invest over the long term? Investing for retirement. Most companies have pension plans, such as 401k, that provide retirement income. Some people will combine a retirement plan with their Social Security checks because Social Security alone is not enough. Personal or private pension plans have the benefit of tax savings. The Keogh plan is an individual retirement plan for self-employed people, where they can save up to 15% of their income. Traditional IRAs, or IRAs allow you to contribute up to $3,000 per year, which is not taxed when put in, and any earnings and interest are not taxed until the money is withdrawn. Roth IRAs, on the other hand, allow you to save up to $3,000 per year, which is taxed when put in. Interest and earnings are never taxed, and money is not taxed when withdrawn. So if you were trying to decide, for example, between whether you wanted to establish a traditional IRA or a Roth IRA, the things you would have to consider, both of them let you invest up to $3,000 per year. Now, if you choose to go with a traditional IRA, what this allows you to do, because you are not taxed when you put it in, this enables you to potentially put more into it. If you're having a hard time coming up with the $3,000, this basically allows you to use pre-tax dollars so that it doesn't count against your tax. That $3,000 you put in would not be considered taxable income, which will lower the amount you pay in taxes now. But you're going to be taxed on that money when you withdraw the money. If, however, coming up with the $3,000 that you can put in per year is not a problem, a Roth IRA may be a better option. Because yes, you're using post-tax dollars, but you're never going to pay taxes on the interest and the earnings that you make, and you're not going to be paying taxes when you withdraw that money. Real estate is a popular form of investing for the future. Housing generally increases in value over time. Buying undeveloped land, however, is a more risky investment. It is hard to turn real estate into cash on short notice, which basically means that it has poor liquidity. You can't easily convert it into cash, which is something that needs to be considered. That is one of the downsides to investing in retirement. On the upside, if you know you're not going to need to gain access to the cash for a long time, it's a pretty sound investment. How much to save and invest? There are many factors involved in deciding how much to save versus how much to invest. You should invest in several different types of accounts to lower your overall risk. This is called diversifying. If you cannot afford any losses, use banks or savings bonds. Your values may affect your investment choices. Some people, for example, may have a very low risk tolerance. And for those people, going with a less risky investment makes sense. Other people have a high risk tolerance, and for them, they feel very comfortable and are willing to take those chances. But you also have to consider, what is your age? What is your status in life? For example, if you are a young individual, let's say you're in your 20s or maybe early 30s, you've got many, many working years left ahead of you. And you can make more aggressive investment choices, even taking a higher risk, because should you lose that money, you have time to recover. But when you get closer to retirement, people that are maybe in their mid to late 50s probably can't really afford. They don't have that many years left ahead of them should things go bad. So they need to play it more conservative. They want to go lower risk because there's just not time to recover should they take a big loss. So, and here's something that, a graph here that kind of shows what you need to take into consideration. Now, of course, the big thing here is that everything comes down to risk versus reward. And so when you look at this graphic, you can see along this axis they run risk, low running to high. And along this axis, you have the rate of return running from low to high. So down here, passbook savings accounts, those offer the lowest risk but also the lowest return. Certificates of deposit are moving up to a little bit higher return, but at the same time they take a higher risk. Bond-based mutual funds. Once again, greater rate of return, but a higher risk. Stock-based mutual funds, even riskier. Bonds, riskier yet, and stocks are the riskiest. But once again, as it moves along this trajectory, the further out you get, yes, you have a greater risk and a greater rate of return. So you always have to balance those elements, risk versus reward.